Morning, Steve Free in Chicago with the morning grain comments. Well, prices are lower overnight. I think the couple of things. Number one, commitment to traders report finally came out and showed that the funds were longer corn and not as short beans as expected. And so this offers a little bit of weakness, especially in the corn market. Number two, I think we're looking at weather over the next 2 weeks that, if the model's all right, would be good for crops. You're looking basically warmer and drier conditions for most of this week. That'll help some of the late planted crops catch up. We have a tropical depression that's going to come into the Gulf of Mexico and push rain up into the southern and maybe eastern part of the Midwest next week. The key will be just how much rain areas get, and if it overall the pattern after that. It looks like parts of maybe South Dakota, Nebraska, Iowa, maybe southwest Minnesota might miss out on some of this rains, and this is where we have the best rated crop. So all in all, the 2-week Midwest forecast looks pretty favorable. Technically, we're back below $9 in November beans. I think that we're approaching some key support areas that if we break down below, we could see some increased spec shorts in the bean market. Corn also approaching some important levels. I think that there's probably more important these corn price levels that are further below than where we are right now. Cash is supportive with farmers not selling until the crop is pollinating. And in the wheat, we have too much wheat. We're still in a trading range. It is interesting, if you look at the Kansas City SEP wheat and Chicago SEP corn, wheat's only 2 cents above corn, so you're probably going to see a larger than normal amount of wheat fed in the Southern Plains and across the Midwest because of this spread. I also see that there was an article out that while the negotiations and trade talks are beginning, it looks like preconditions by the Chinese is more than maybe what the U.S. is willing to accept. So we don't really see too much there that's going to help the market. We did note that the USDA ag attaché in China did lower this year's soybean imports for China 1 million tons to 84 and lowered next year's 4 million tons to 83. And I think this is on the ongoing impact that the African swine fever has on the demand for meal domestically inside of China. The crop progress had 47% of the winter wheat harvested. Crop is still rated 64% good to excellent. Corn is rated 57% good to excellent versus 56 last week, and about 8% of the crop is pollinating versus 22 average. Soybean crop is now rated 53% good to excellent versus 54 a week ago, and the spring wheat is 78% good to excellent versus 75 last week. And so I think this rain event next week will probably help and be more important to the late planted soybeans than maybe the corn. We did note that the one private crop watcher did take a survey across northern parts of Illinois and found the crop later than expected, and the soybean crop smaller than expected. His estimate of the corn crop is basically 12 billion bushels with 85 million planted acres and a yield of 160, and his soybean crop is around 3.6 billion with 82 million acres planted and a yield of 45. So the funds right now, we estimate them to be long about 40,000 Chicago wheat, 200,000 corn, and short about 40,000 beans. And so we'll just kind of see how all this unravels as far as crop conditions. We've got a report this week by the USDA that probably won't be as bullish as maybe the supply bulls would like to see. And I think right now the demand bears have a little bit more edge in price discovery than the supply bulls. As always, these are my thoughts and not those of ADM or ADM Investor Services. Have a safe and profitable trading day.